And this pivoting point, we are but in the beginning era of the rebalancing of a hyper undervalued capital preservation tool in an environment of hyper overvalued, no longer yielding in real terms, search for yield era. And I think when you understand that, you will understand that pullbacks are going to disappoint. People that aren't in, that are thinking they're going to get 30% retraces, are going to get disappointed. The oil tanker has finally turned on this one, and there's no turning it quickly back. It just doesn't happen like that. So it's going to run its journey now.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend, the market sniper, Francis Hunt. Francis, thank you so much for joining us today.
Delighted to be back with your audience. Thank you for inviting me, Elijah.
Well, it's great to have you. Since the last time we talked, gold and silver have hit major key points there on a technical level. They've really surged higher. We're seeing a bit of a pullback here. Your perspective, where we are right now?
A very good place to be. I haven't always been super optimistic. We've warned there's been dips, so we're not perma bulls. The technicals are very good, and it's almost worth, as someone who emphasizes the technical, to get straight to the shares and take people into the dive of where we are. Everything is compliant to what we typically expect. I'll start actually on the smaller time frame for a change. Normally I go macro to micro, but just around the pullback now, that might get a lot of people, oh dear, it was all just another cry wolf session. People have been so hurt, burned, that there's almost a psychological PTSD sometimes with the precious metals bull. And I'm here to say this setup, this little structural setup, you see it setting up on I'll highlight it. This is on the 2 hourly. This occurred as we broke this big red line. That was the flag on the bigger time frames. I can do a quick show of that for those that have forgotten it, but I think most people are familiar that we ran a key flag level, and this little wind up gave us a short-term target of 2043. We've had this draw. It's the same draw we showed you last time we were on. You've made that 2043. You squeezed into a bit of a rising wedge, and you get a bit of a technical pullback, and that's kind of what you have here. And already this is what we refer to as a broadening structure, which means it starts to base out. So you had your slap in the face, bang, you had one attempt rally, bang. You typically get the selling in 3 legs. There's the third leg, boom, bouncing on our axis of this funnel. And now you're getting a rally out. I don't think there's too much more long-term downside here. You start to base and you go again. It's worth just reminding everybody, where's this little fractal taking place? So I'll take you back up to the bigger time frames and clear the face, just so that you know where in the map we are. If I just take all the lines off first so that everyone can recognize the chart, this was the level that we saw being run here that you have broken. And this is a key technical level. So this is the structure of the flag in essence. And I was showing you what's gone on in this little circle on the lower time frame right there. So it's absolutely natural short time frame technical pullback. They're not going to let you have it all your own way, and it's all going to be straight line stuff, gold up, up, up. You saw it here when we reached this level. We had a first 50% pullback. Every other time you had the full pullback. So you can see by degree we win out. By degree. So first you touch a level, then you straddle a level, then you bypass it. So there's all these, and you need that patience. And precious metals people have nothing if they don't have patience. And if we look at the silver, while we good to go, and I'll bring that fella up for you as well, Elijah. What was seminal about the silver is that we also got a key technical run on the silver. And I think there you see it there. So I've done similar draws. Now, silver being the slightly more volatile one, has had a nice, interesting and bumpy ride. It had a harsher pullback, but it's from the March 2020 lows. That was the Wall Street Bets wick high out of time frame. And if we have a look at this, I just want to, there we go. We've had two technical breaks since I last spoke to you. There, at a possible level. Sorry, I keep pulling a label up just where I don't want to have a label up here. And over here, we've broken properly. So silver has now joined gold after initially lagging. And we've also been the guys that have regularly spoken about gold-silver ratio for you. And so this is a huge technical break, by the way. This puts to end this entire consolidation. You've got to remember, silver moves fast in very short times and then consolidates forever. So the time frame here was super quick from the March 2020 lows, and you did an immense amount. And then you've stood the patience of a monk waiting for this consolidation. This is a big, big moment, but we've yet to get really, really aggressive to the upside. So there's a lot to look forward to. That gold-silver ratio that I was threatening you with, we've been the proponents that say this is a macro head and shoulder and that you'd have a pull down on this. And that's absolutely taken place. So just again, to show the big picture, this 65 level is a neckline for us. This was an extreme. This was a reversal of the financial system's basis on debt. We called the debt market reversal. You've got to remember that fiat currencies are borrowed into existence. That was such a key event, March 2020. It's worth just showing this one more time on the bigger time frames. That was a seminal event. So we've said bond markets have reversed, and that affects fiat currencies as well because they borrowed into existence. That is the turning. Who gains? The physical money, precious metals. So this was a very abrupt sell-off, and then we've said you're in a broadening structure here. So I'll take you back down to the weekly, and we'll just focus on the more recent time frame. And this is this broadening structure over here, and that tends to resolve to the downside. So when you're going up, but it's getting more and more volatile. So initially you're quite low vol here, where I am, then you're going up. Then you have a squeeze to go a little higher, and you break up higher, and then you start getting more violent swings. This is the beginning of what we would expect to be the end of this level of gold-silver ratio. So the next price action we would expect is through the 65. And then we'll bounce on the neckline again. It's a critical area for break. There's one mathematical thing I want to point out that's going to be super interesting, and then I'll let you unpack anything you want here, Elijah. But the amazing thing about technical analysis is you can do technical analysis on different charts, and you can triangulate a potential scenario. And in both instances, I'm getting through $2,900 for gold. And then I ask, well, if we have the gold-silver ratio at that time, when we're likely to rest, and they coincide typically, they will coincide. When we rally here, that'll be likely when the gold 2.9 is probably up and it's having a bit of a pullback by a few $100 maybe over a number of months before going again. So this is the first leg of a macro bull. This is not where gold ends up. That's my big call. That's the first major leg. It's still a 50% plus move. Where will silver be? Well, if we're at 65 and gold is, let's just say $3,000, keep the maths fairly simple, where will silver be resting at the point that gold and the ratio will rest? And I will bring up a calculator for those that don't enjoy mathematics so that you can follow me. But if we have gold up at 3,000, and I was just testing this math for you now, 3,000 gold, so that's the run of the 2,905, and we bounce at 65 gold-silver ratio, divide 65, what will be the silver price? And you see I'm getting around 46. Now remember, we'll probably technically run through the 65, so it might be 63, 64, so it could be 46 to 47, $48. Now many of you historians will remember that 49 is kind of our top mark. We had 48 in the 80s, we had 49 in 2011, and that's been our top mark. So if we go back to our silver chart, what technically were we getting on the projection? So we're getting an answer from two different exercises, utilizing two different things. So we made not too big an assumption, but we've said when gold rests, where will it be? And in the same way, this target, where will the target out of this be geometrically produced? And charts have a very, very powerful geometric response. The energy taken to push it down is often replicated and unwound to the upside. So if we go there and we clone that line, and I'll put in the log scale there, and we clone that line, there it is, and we project it up, this will give you your target where you should approximately be at the highs. And if I take you back up to the top of the screen, you're seeing $45 as a target. So it's very interesting that technically off the chart, we're getting the $45, $46, $47 range, which is also a known legacy previous highs level. You start to run into the historic moments for silver, and at the same time on the gold and silver ratio, we're getting a similar thing. Gold at 3,000, 2,900, 3,000, and about 65 silver ratio. That's the first major leg. Don't forget, we will drop on the gold silver ratio if that head and shoulder triggers through 32.8. And gold will have another leg up, so you'll now be 32.8 of some higher gold value. So the silver bulls, that's not your top call, that's the next leg call. So hopefully that was an interesting exercise that you enjoyed.
It definitely wasn't. It seems like what you're saying is that the $3,000 for gold and the $44 to $46, $48 level for silver is just the next leg up. Who knows where it could go from beyond there. I did want to ask you about, because we have seen such a dramatic rally in the last couple months, and it seems like we're kind of from one point of view, you could kind of see it as topping out right now. Do you see that gold has really made a floor at 2,000 and silver a floor at 25, or do you see potentially we could actually go below these levels before making that next move up?
That's a good question. I mean, on the cash market currently, we've got a number below 2,905. I see this red capping level as now a support range. It's not a fixed level because it is a descending line, but I'm seeing overall this range now proving as support. It's a bit of a messy chart to see there. I'll draw it again, overlay like that. But I see this overall a bit of a support. That doesn't mean you can't come a little bit down, but by price level, I don't see we going below the 1930s again and possibly higher than that. So you could chop and churn a tiny bit, but I think the next move probably is going to be to continue up. And I think that I'm more eyeing the localized highs falling and the ultimate high than too much concern about the upside. That said, this technical price behavior is a slowing down. You come very strongly off the base there. You came very strongly up here. You got a reaction down, and then you came very strongly up here where you broke at this point here. So now you're seeing a little bit of that momentum decay. So there is space for some corrective drift, but I don't think you're going to get anything to. You don't put the genie back in this can. This is the first time I'm saying, and that this trend of 40. So here's a small analogy. I want to take half a step back. We had the search for yield era. Gold was denounced for not having yield. This is the thing Buffett has always said, oh, it doesn't pay you any interest, it doesn't pay any of anything. So everything became about yield. So we've essentially had a financialization of anything that produced yields, which is essentially debt, interest, property, which pays rent, anything that produced rent, rental extraction. These things have all gone completely crazy for 40 years in hypervaluation. Gold being punished, ignored, super undervaluation because capital crowds around the yield now. This is the theme. But the problem with the yield now is actually those yields are not strong. They are actually negative in real terms now. And in actual fact, crowding out the yield has seen such hypervaluation. You're overpaying and you're actually getting a negative yield. And gold is compensating for not yielding by getting capital growth. That is surpassing the fact that the inflation rate is gone. 2 very good years in a row, the best instrument to have now that we are in this hyper-stagflationary period, which is bad both for growth, bad for asset prices, bad for yields, and bad for real yields in terms of inflation. So what you're now seeing is capital is going to start reforming. Never mind yield, capital preservation is the theme. capital preservation theme, and you get return out of that, but it comes in capital growth out of a non-yielding asset that has been hyper undervalued while you've had this 40-year bull cycle in yield appreciation. And this pivoting point, we are but in the beginning era of the rebalancing of a hyper undervalued capital preservation tool in an environment of hyper overvalued, no longer yielding in real terms, search for yield era. And I think when you understand that, you will understand that pullbacks are going to disappoint. People that aren't in, that are thinking they're going to get 30% retraces, are going to get disappointed. The oil tanker has finally turned on this one, and there's no turning it quickly back. It just doesn't happen like that. So it's going to run its journey now. And this journey is going to unfold. These are macro trends. That's why we like macro technical. We're showing often weekly and monthly charts, even annual charts. So this is a really important move. You don't need to be a day trader or even someone who's getting in once or twice a year. This is a long-term hold for stagflation, hyper stagflation we've made the case for before. So I think that's the fullest answer I can give you on that.
Speaking of the macroeconomic factors here, if we could turn to what the Fed is doing, what's happening with the US dollar, and also de-dollarization around the world, starting with what the Fed is doing and inflation, we have inflation cooling off a bit and obviously issues in the banking system that could pressure the Fed to possibly stop raising rates, or some people, it seems like, are saying that they're going to continue to raise rates. How do you see future rate hikes or the lack thereof impacting the metals prices here?
To your question regarding Fed and interest rates hikes, this cycle is so far gone. It will just be the degree that they relent or they continue to try hold up their game. So if they don't increase rates, it's going to be a further accelerant, in my opinion, for gold. If they increase rates, it might take some of the move out, but as long as people are perceiving that there's still, in real terms, a negative interest rate differential, it's just been brought down a little bit. It's still going to bring gold up, but it'll take a little longer. They might be able to slow it. But in the meantime, they're going to pay very heavily for that in terms of the fact we were in a technical recession when the technical criteria were met some time ago. Workforces are being reduced. There is an immense economic contraction. Asset values are coming down. Banks aren't lending. Subprime costs, subprime housing all over again. All of these various things. So they're going to be put under huge pressure of a different variety. So they've extended the cycle too long. We had Larry Fink that I mentioned that was talking up a few more interest rate cycles. And I think that is potentially function, Elijah, as part of they're worried about the de-dollarization being almost gaining too much ground and too many people suddenly realizing it. It's a tipping point. Too many people. When we called bonds having turned, no one believed us or even taken us seriously. Now people are saying, I don't think debt's ever again an investment. You can trade in, the rallies and the pullbacks, but overall, this thing has gone too far. We're going to have a major unwind. It's not paying real returns. Everybody's now on that page. So it's kind of a tippening has happened with realization on fiat currencies. And the biggest beneficiary of dollar dominance being reduced is not the yuan or the euro, which have both got a bit of a bid and have benefited to some degree, but the dollar, as I've said before, is the god market of fiats. The anti-fiats are the category that benefit in the loss of faith in fiat systems. People don't run to another fiat and say, the euro will save me from the dollar or the yuan. Whilst they will rebalance a little bit in their fiat holdings, the real demand is coming on the anti-fiats, which is also why we call the Bitcoin turn. And we're very bullish the metals, and we think that that continues to run for a lot longer. So they're trying to manage the fact that too many people are realizing this. Also, if you've got geopolitical events such as China reaching for Taiwan, and you maybe had Trump in the White House, or anybody, and they decided to go financially on sanctions, that is going to just further capitulate the de-dollarization trend, especially if they were, taking treasuries off them and you didn't pay this, anything like what they did to Russia, only on a much bigger scale. And the fact that they've already stood on one landmine and some parts of government are admitting that, doesn't mean they won't, with the last good leg, find the other mine and do it, only it's a much bigger mine. It won't just take the leg off. And that's a warning, I would say. And that's further good for gold, by the way, because it's just going to see people go, okay, we don't know what's the new king. We go to the old faithful of millennia, which is gold and, of course, silver for this as well to benefit.
It does seem like you're seeing two things happening at the same time. Obviously, the sanctions and all of that has led countries to go towards de-dollarization, being less dependent on the US dollar. But you're also seeing a crisis in currencies in general at the same time that is kind of a separate story from de-dollarization itself.
That's right. Many people will say, but the euro's gone up and the yuan and all of this. Those are minor levels. They've underperformed for a long, long period. Don't forget the dollar was quite dominant, something we predicted and showed you the technicals on the dollar index when we said that it'll run 114, and that it did do. So there will be these periods. So during those periods, all the other world currencies were failing. And in fact, gold's at new highs against most currencies, with a very few exceptions, particularly the emerging market currencies. So it's masking the fact that we do the cross fiat means you're still playing in the same bubble. The real winner is the anti-fiat category, where you can't proliferate, you can't print, that there's real energy. And by the way, did a very interesting discussion. Oil has been stubbornly strong, even though natural gas is off and uranium is off. But the costs are going up ever more, because people often ask a question why the miners aren't yet moving. Well, A, they forward sell, so they don't get the immediate benefit of short-term price moves. B, silver's very volatile particularly, but both are. So, one swallow doesn't make a summer. They want to see years of sustained high prices before you get regret. But their costs, the energy required to bring up rock, break it down, and do this from deep in the ground has gone nothing but up. So we've had the inflationary effects on that, and the costs keep coming up under this price. In fact, metals are barely above a reasonable return beyond what most people calculate as cost, reasonable costs with normal profits, paying workmen just to be viable. 18% of silver is actually by pure miners. That's less than 20%. The rest is it's a side hustle that they get out of their copper, their tin, their nickel, their gold mines. So you have a real problem on supply, potentially on the silver side, because you just don't open mines. And all these green agendas that many of us are a bit circumspect and maybe don't like too much work in your favor because they add barriers to entry to new mine access. So there's going to be a lag effect of if we start to have supply shortages to being able to meet those. And the energy costs are remaining high. So the only thing that fixes that is significantly higher prices, Elijah. And as the fiats as a whole are all going down, we're having devaluation. So energy up, fiat's down, you need more money to start mines, and it's going to take longer to bring them to market as well.
Yeah, it is interesting. If the silver price spikes, it's not like new companies can start mining right away. It takes years and years to develop mines. So you really could see a squeeze in that circumstance.
Especially if you've got some true price discovery market mechanisms, which, with China and Russia possibly opening exchanges and real delivery taking place, you could start to see a bit of truth breaking out. And that could be very, very destructive for both the COMEX and super spikes. You'll just get unobtainium, as many people like to say. They just won't be able to do it. And state will step in. It's almost too good in that it could become dangerous. This is where I've warned previously, and I know I got a bit of feedback, negative feedback last time I said, you could get state intervening to nationalize mines. You could actually get demand, you pet rock guys, holding your metals has caused, we can't pursue the green agenda. Your unnecessary pet rock collecting is causing shortfalls in the market. We are obliging you to sell to the state. It's strategic. It's required. Those kind of possibilities aren't entirely off the table. I don't think they're the thing you should be worrying about. But, if we go into what you just described, a super spike and unobtainium, they're going to want it for what their needs, and getting a new device out for tracking citizens on their new polished phones, having the silver to do that, they're going to want that metal. And they're going to treat us as sound money participants as the people that have hoarded it into a supply shortage, rather than owning up to their central banking owning their proliferation game as being the real reason why we're in this hyper-stagflationary state, and that we are just responding to what is around us and the situation they've created.
Now, we did have a viewer's question on a topic you brought up, the silver price manipulation. Obviously, this is a controversial topic. We'll put a link in the description of this video to a playlist we have of diverse views on this topic. But this Randy wants to know, when will the price controls on silver end so it can free itself and go higher?
I think that's going to be a combination. They're going to. So the key thing is, when someone cheats, is he tries to cheat for as long as he can get away with it. So until they let all things fall down, I think they're going to attempt to hide that, because silver and gold are the canaries that they don't want to tweet. So their beaks have been tied, and they're in the gold mine, and they're smelling the gas. So until the gas is about to overwhelm them, we're not going to get the news. That's a general comment. But if enough people are taking physical delivery and taking it out of system with vaults that aren't involved with banks, aren't lending or creating lending contracts, and people are stopped trusting even the vaults in banks, and they start taking it home, you start to undermine the derivative system, because then there's nothing underlying that. You start to have too big a pyramid, too broad a pyramid standing on too fine a point. And then a little bit of delivery and shortfalls. Once the above ground is being consumed, you start getting close, then reality will bite. And that's, I'm surprised Elon Musk hasn't quietly bought a few silver mines yet. We've had the runs on rare earth minerals and all of that by China and many other places. So in due course, I think that moment is coming, and it's going to take taking the metals out of the system to do it. Don't buy ETFs, sell out your ETFs, take physical. If we can get more people doing that, we can bring that moment of truth sooner to eventuality. But I think eventually you can't stop the tide from coming in. So even without that level of cooperation collectively, that moment will come, and walls built on the beach will get washed away.
It is an interesting concept of buying like paper gold or, ETFs and stuff like that, where it introduces a third party risk in some sense, when you can just hold the physical metal yourself, or have a trusted storage facility hold the metal, allocated and segregated for you. It's a very different, investment in that respect. One of the main reasons to invest in precious metals anyways is to reduce third party risk. I did want to ask you about that as well with respect to other investments. We have a viewer wanting to know about stocks. I guess mining stocks would be an example here. Are you concerned about any third-party risk there when buying stocks of any kind in the environment that we're in?
Yeah, I am. I think this will be the era of counterparty risk. I think many people, the sea's going to go out, and most are going to be naked. I would say to anybody who's thinking of trading silver long on the basis he thinks you'll make more money, that you could be forced out of your positions, you could be closed out, margins could go to ridiculous heights overnight, and they'll blame speculators as the reason. The best way to benefit from silver is you let the move make you the money, and you hold it physically yourself. So for those planning on trading it, that will be a bonus. I think brokers are going to be forced to shut. So, and I think brokers will even go bust. Brokers rely often on primary dealers. Primary dealers will stop offering a bid and an ask. We're going to see counterparty measures that you've only witnessed small microcosms of, like on MF Global and various errands. Only you're going to see it across the board. It's the same with bank failure. We've only seen individual bank failure. We haven't seen wholesale systemic failure. So counterparty risk will be the theme with wholesale systemic failure. If you don't hold it, you don't own it. It's going back to primitive. Derivatives, paper, and contracts are going to be an absolute problem. People are going to renege. With regards to shares, because you asked a question surrounding shares, it's best to have the good old-fashioned share certificates in hand, or digital versions thereof that you've saved on a hard drive that's off-grid, can't be contaminated or edited or anything like that. So when you purchase, ask for share certificates, and you can even get the physical ones possibly sent to you. Pay the $30 if there's a charge to own your shares in those silver miners. But the concern with silver mining is be careful. There's also going to be a lot of possible speculators that have overstated their hands if they're not already mine ready and production. So a producing mine is better. Sure, have your gambler's pot. If you've got 100,000, put 10,000 in microcaps that claim to be working towards getting production ready, oven ready, and have 100 million ounces in the ground. That's done by a proper metallurgist. And all the reports are on order. But recognize there's much more risk to that. There could be 10 years, and you might be in a buyout situation, et cetera, et cetera. You're gonna have a call option on the price, essentially. But bad management or falsified documents or bad reports. We've had the BRIEX events, if you remember 2011. So start safe. Have the bulk safe, then have a few gamblers. It's a bit like if you're in the crypto market, hold your Bitcoin, but feel free to have a little bit of ADA and a little bit of the others and even go further down. But your weighting should be something where the risk is already reduced. The points of failure are greatly reduced.
And mentioning crypto, I know that is a market that you track very closely. We have a viewer wanting to know, are we in a bull market for cryptos, or is this merely a bear market rally?
Yes. So good question. And it's our personal opinion that we are in a macro bull market reversal that has already triggered. It's not a bad idea to have crypto. I would emphasize, don't always chase to what you think will be the fastest horse, which in many instances could indeed be crypto. You should have a stable of horses. Crypto has got advantages in speed and digitization, and those things are also the weaknesses. They're surveilled, it's monitored, there's blockchain. I've often thought that Bitcoin has been a great on-ramp learning stage for the eventual CBDCs that I'm sure we're going to be exposed to. The whole Satoshi Nakamoto. I don't overweight fairy tales for adults too much. I don't know what's true, but I don't give my belief easily to anything. This is a left shoulder on what we would call a head, and there was a small squeeze right shoulder, and that was a very clear $25,000 key triggering event. So that was a definitive break for us in a reversal. Also, if you have a look at the durations, even if we take it from the high, this is typically well through a year duration for the bear. So it meets and is actually rather long for a bear duration. In my personal opinion, Bitcoin was at its most powerful at the 64 high. If you look at it against gold, it was the ultimate high. If you look at it against the NASDAQ, it was its ultimate high. If you look at it across others. So that just further extends the period that it's actually in bear. And there was actually a momentum drive that saw you go technically marginally higher by a handful of dollars. We also made this head and shoulders target as well. That's this fella. That's the ultimate high. That was done recently. It took you right the way down to 15. So we've had some excellent geometry come out. So I'll just put some of those lines on now that I've explained it, because it can get a bit overwhelming as a chart. But I've got a lot of overlays. That's that head and shoulder. There's that target picking the lows. I've got a lot of text because I've done annotations on lower time frames. So sorry for the bird's nest appearance on the lower time frame there, but just capture the big feel of that. That was a target coming from that triggering event there. That was that head, and that was your ultimate high at 69. So that's very much picked a low for us, and you have a similar structured pattern now on the reversal side. So if you look at this on the reversal side, we're now making it up. What people are concerned a little bit about is that you've had a little bit of churn. See those small bodies and wicks? Those are often a sign of indecision. Then you pushed a tiny bit higher, and you've got 30,000. I've actually just done, as I say, a lot of work on the lower time frames for our community. So if I just take you into the lower time frame, people will be asking, but it's going down at the moment. And this is how we framed it. So this for us is part of a bull flag price action. So I just capture some of this, and again, I'll just spread this out. I've just done a detailed draw and annotation, as I say, for the community. So you've got lots of little head and shoulders in here, but overall, the key message here is flag. So there is an orchestrated pullback. We split our flags like that, but that is a bull flag. You're bouncing along the basing descending grind line, we call it. That's the base there. You've just had a strong sell-off to the downside, but you've already had a similar strong sell-off, which you rallied quite substantially. So there's been a bit of a reaction at the 30,000 level. You'll note the 30K here. This runs perfectly through the diagonal of the flag. So the next move is, I was discussing how you overcome key levels. First, you trade and you resist. This was the resistance. Here, you can see we got sold off a little bit, small pullback. Then you get above it, then you get back below it. So you straddle it a little bit above, a little bit below. So overall, there's been quite a bit of that going on in Bitcoin. So you've been going sideways. But a lot of little head and shoulders formed, and that just let some of the pressure out. So this left shoulder, for example, this is really low time frame analysis. We don't encourage getting too low. But the key point is you're in a macro bull, so we only go long. That was a head and shoulder for us. Bit of an extended right shoulder, key break there, made the target there. Next thing you know, you're rallying back up to that neckline there. Then you spill at the same cluster of levels. You've got a number of levels. The 64,000 head and shoulders from 2021, that target is in there. The upside HVF we traded, that target is in there. So this is a very populated zone. There's a lot of reasons why the 30,250, you're wrestling with it. And in time, you'll break through it, and it's part of this flagging process. So the short answer is flagging, but inside of that, there's been a lot of interaction with this zone here at 3250, which is about $250 over the 30,000, and then you've traded a little bit below the 29,800. You can see here, this blue level, bit above, bit below, flagging. A small release, marginally lower lows is actually bullish. So marginally lower low, marginally lower low, marginally lower high. On a flag, it's bullish. On a bull pole, don't forget we came up strong into this. So the next move is when you're breaking this level to the upside, and that'll give you a great move. So we've got 40,000, then 42.5, which is a neckline of a legacy head and shoulder that we think you might rest at. But again, we expect further highs. So you may find, as gold does 50%, it would be great if all these things coincided, because I'm in all of them. As gold makes its 2.9 and silver is making its 46, 47, maybe $48 run, you could have Bitcoin back at 42.5. From current levels 30, it's a pretty reasonable move. And it could extend beyond that as well, likely to have a bit of overperformance in it. So yeah, that's the take on Bitcoin.
Fantastic. And we do have one last viewer's question here, kind of on the macro side here. They ask, if the dollar is going bust, what happens to Bitcoin?
So I don't think the dollar is just going to disappear. It's going to be, America's a big, sizable country. It's not going to disappear. What will likely happen is its currency dominance is going to be decimated significantly, and there will be a fragmentation. So there'll be lots of alternatives. There'll be derivative markets in yuan, maybe ruble, or a variety of currencies. There may be a woku. There could be a general CBDC for the world and then nationalized CBDCs. And so many CBDCs of Brazil equal one New World Order CBDC. You could have layers of this. So we also, don't forget, as fiats are running out of favor, central bank digital currencies are a great opportunity to reset and start another debt cycle again, but this time with a different mechanism for doing it. So there's a lot of debt that's going to die. Do not be long bonds. Do not be expecting your pension to pay out if you're sitting with debt instruments, treasuries, and everything. I have de-debtified, if there's such a word as that, all my life. I see the assets devaluing along with the liability, and I see them going crash bang and substituting something in lieu of that, which will be a very poor trade. Like a UBI system, and here's some central bank digital tokens, and then wiping the slate so that they get a new start with this new surveillance technology that they're keen to bring. So the dollar's not disappearing in that. What potentially is happening is CBDCs are being launched globally, and it's going to get lost in the masking effect of debt devaluation. And the debt devaluation is not just going to be on dollar. It's very difficult to measure just dollar because you're going to have euro debt devaluation. You're going to have yuan debt devaluation. So you're going to get, relatively, you're all terrible. It's like one piece of fertilizer calling another one more stinky than another. You're all in the same bag. So the relative valuations can actually, you could still have, as part and parcel as a fight back, a dollar spike. I haven't ruled that out. We're looking at the Korean War. We're looking at, wars. These sort of things could still see dollar gain some dominance. It's still a very big military that has got a lot of very high-tech weaponry. So see this rather as fiats versus anti-fiats. Change your framing. I almost want to change the question we were asked and say, don't compare one piece of fertilizer to another. Get out of the fertilizer business, get in a better currency business, because they all stink. And the relative valuations within that bubble means you're caught in a specific framing. The focus should be anti-fiats. There will be upside moves in the dollar still to come, in spite of everything that's going down. But its dominance in the world trade system is going to continue to ebb. And it's going to be like the British pound. The British pound still exists. It hasn't gone away. But it's no longer really that important. I don't think the dollar falls as far as quickly, but it's going to reduce. But it's still a major nation. But all of this is going to be changed for something else, and the best game is the anti-fiat category. So in some senses, I think it's the wrong question to ask, but with respect, I'm giving my answer to it, but at the same time, maybe reframe the thinking.
Fantastic. Well, Francis, we really appreciate your insights today. If our viewers are interested in learning more about the Market Sniper, where can they go?
Pop over to themarketsniper.com if you'd enjoy a call for detailed breakdowns, regular updates on what we think the market's going to do next in all the key categories, anti-fiats and currencies. They're great shorts to be taken in currencies. If you understand what you're doing, we're going to be seeing a lot of value created for those that are being short. You saw The Big Short, the movie. This is going to make The Big Short look like the tiny short in terms of what we're going through, in my view. And to the long side, if you're only comfortable long side, be investment, and you can trade despite counterparty risks that do exist. And we're here to help people build wealth during what is the reset season, a very specialist season where you need zero debt and you want to be anti-fiat long by investment and trading all the other instruments in both directions.
All right, Francis, once again, thank you so much for your time, and God bless.
Same to you, Elijah. Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.